It's a perfect storm for supermarkets right now. You've got Amazon coming in most obviously. You've also got European discounters like Aldi coming in, putting pressure on prices. Costs are high, transport and logistics costs are high. Consumers are changing the kinds of foods that they want to eat. So supermarkets have to respond to that. It's a million things at once. And I think Kroger has been very innovative and very bold in responding to a lot of this in a lot of ways. But the pressures on the industry are just too much. And that's why the stock is down today, I think.
Scott, do you agree with that? And if Kroger says, well, maybe we can play the sound from the company's CFO this morning when he talked about some of the reasons why they had this mixed news. Take a quick listen.
With our launch of Kroger Ship, that we made some investments in the fourth quarter, which was part of the margin erosion we saw in the fourth quarter, we would expect to be able to serve 100% of the United States by this time next year.
So again, that was the CFO, Scott, and he's basically arguing these are investments so that we can be competitive in the future. We've seen it pay off for Walmart. We've seen it pay off for Target. Why won't it pay off for Kroger?
Well, I'd actually argue maybe it's not paying off for the other two. So, I mean, as you take a step back, and I agree with what Aaron said, I mean, there's so many changes going on in the food at home or the consumables industry. The first thing is, I call it destination unknown. We're embracing this idea of omni-channel, but no one understands how we're going to make any money. I was just out at the Shop Talk conference out in Las Vegas, and it was a big topic of conversation. Met with some grocery people out there. We're going this direction, but no one makes any money. In fact, like if you look at Peapod, which is part of Stop and Shop, but also Ahold, they've been running that for a couple decades. They don't make any money. And so I think the challenge is it's great to make these investments. It's great to go omni-channel. It seems that's where the customer's going.
Right.
But we're not making any money, and you saw that in Kroger's report. And the challenge you have, and it's a huge, huge challenge, is Amazon is redefining consumables industry.
Okay.
Everybody is moving that direction, and even Walmart is struggling. They said it on their conference call that their omni-channel business is losing more money than they thought it would.
Aaron, how would you, again, sort of talk about what's happening in the grocery category specifically? Because my point, when I hear what Scott's describing, I say, well, then if I'm Kroger, some of these others, I just wait this out. I say, no one's going to be profitable in the long run. We at least are an existing company that still brings in cash from our locations and are a real business. So if that means ultimately prices are going up after everybody goes out of business or however it plays out, it might be uncomfortable for a while, but we'll be left standing. Is that not going to be the case?
I don't think they can be that complacent at all. They have to make sure that people have a reason to come to their stores. I'm just speaking from personal experience. The amount of stuff I buy online now versus 5 years ago, including a lot of stuff you get at the grocery store, coffee beans, laundry detergent, all this stuff, you can get delivered to your house. And if Kroger doesn't respond to that, they could be in real existential trouble. So they have no choice at all but to make these investments. They're investing in delivery. They're investing in, order online, pick up in store. They have a stake in Ocado, this UK company, which is building robotic warehouses for automated grocery sorting and delivering. They bought Home Chef, which is a meal delivery company. They're saying, look, however you want to get your groceries, we'll find a way to get them to you, basically, whatever you want.
Yeah.
But that costs money. And the worry, as Scott was saying, is how do you make money on this? And their margins are under pressure. That's what was really not looking good in the quarter. Their sales were decent, but their margins took a big dip.
Yeah.
And they didn't want to give very specific guidance on where margins are headed in 2019. So, that's the question. You make all these investments because you have to. Can you ultimately do that profitably?
So, Scott, you have a $25 price target, which is right about where the shares are now with an underperform. When would you feel comfortable saying that you can see a path towards a higher price for Kroger?
I mean, I think, for the entire industry, as we said before, it's hard to understand the path to profitability. The biggest guy, one of the biggest new entrants you're competing with is Amazon. And of course, they have a huge advantage as we all pay them $119. So the challenge you look at Kroger sometimes is, where analysts go to the numbers. For a decade, the company has seen their EBIT margin, ex-gasoline, fall about 10 basis points a year. That was offset by very strong sales, somewhere between, say, 3 to 5%. As we move out, it's hard not to think sales are a little softer and that margin pressure remains. And so discounted cash flow, DCFs, which we like, discounted cash flow analysis, shows us the stock's worth about $12.
Wow. Okay.
And so Kroger's got a tough road in front of it.